What's up guys, Raymond here with another video, another financial statement analysis video. We're going to be doing episode 17 today of our German industrial stock list analysis. And without further ado, we're going to start with the key ratios. If you're new to my financial statement analysis videos, what we do in these videos are we analyze the top 3 financial statements relevant to a company, those being the income statement, the balance sheet, and the cash flow statement. We try to come up with an overall idea of how well the company's done up to this current date financially and how well it will do in the future, just to kind of get an idea of how great a company is as a financial investment. So let's start off with the key ratios. So we're going to start off with the market cap. That is the overall price of the company according to what the company is valued by the market, which is 1.34 billion euros, which is good. It meets the 1 billion euro requirement that I would say determines that a company is safe enough to invest in, all things considered, financially. The PE ratio, which is the price to earnings ratio, kind of depicts the overall priciness of the company relative to its earnings, which is 10.68, which is good. I would say about 10 is a good PE ratio for any company. Of course, you need to consider the size of the company, the reputation of the company, etc. When looking into the PE ratio. Some companies have a larger PE ratio because they're more trusted by the market. For example, the Apples, the Microsofts, etc. The earnings per share, which is of course quite self-explanatory, is the amount of earnings that the company's made in the last financial year divided by the amount of shares outstanding, is 2.62. And the revenue figure was 4.24 billion euros, which of course is a lot larger than the market cap, but we're going to check the profit margin to see if that figure is larger than the overall price. If so, then we need to check how the company spent that profit to determine whether or not we're getting a good bargain. So the dividend yield, 2.43%, which is of course half of what I would say is the minimum requirement to classify a stock as a dividend stock. The beta level is about 46% above the market average, which of course is not abnormal, because the market conditions, the economic conditions that are present are not necessarily they're not necessarily favorable for companies, for the stock market as a whole. So it's expected for companies for stocks to be quite volatile, for people to buy and sell shares quite frequently, and not necessarily to hold stock market positions. So let's get into the income statement, which is the first financial statements. As you can see, the profit margins are quite low, but then again, the overall revenue income for this company is quite large, as we saw, 4.24 billion euros. But then again, even the profit margin wouldn't necessarily be a large amount of that. So I think it hovers around 5% or lower. 5% probably being the max, which was in the 2021 financial year. And the 2020 and 2019 financial years were about half of that, so around 2.5%. Let's get into the balance sheet, which shows how well the company manages debt and how well it delivers dividends, etc. So as you can see, the balance sheet is one of the most important financial statements, because it determines how well the company manages to be productive without having to borrow too much, without being over leveraged. And as you can see, the company is quite leveraged here. So the company, the dark purple figure represents how much the company's borrowed, and the light purple figure represents how much the company has, how much it owns. And the dark purple figure seems to be almost as much as the light purple figure, and what companies need to do is try to avoid that. And in this case, the company is, I believe, over leveraged. It's borrowed too much, so that could be bad, because it exposes the company to all sorts of risks, especially credit risks. So credit default risk, because the company might not necessarily have enough cash on hand or generate enough profits to be able to cover its interest payments. And if you defer interest, well, if they're allowed to, for example, if a lot of their liabilities are eligible for deferred interest, then what might happen is, if they default on the interest, then it could be added to the principal, and then that could just exponentially increase the amount of liabilities that they have, and also it could damage their reputation. That process is called negative amortization, which I might be covering in another video. The cash flow statement, which is the last of the financial statements, which we'll go into more detail on into. Starts off with the net income, which was 267 million euros in 2021, which is of course good relative to how much the company generates in revenue. The cash flow for operating activities was 250 million euros, which of course is good. And of course, we usually see a negative figure with the investing activities. It shows what the company invested in, not specifically, but just generally. And 89 million euros was spent on capital expenditures, and the rest, 24 million, was spent on other investing cash flows. Sorry about that. The last is cash flow from financing activities, which of course usually is negative as well. It's 321 million euros. It shows how much the company paid out in dividends and how much how well it's managing its debt, and also whether or not it bought back any stock. So the company didn't buy back any stock this year, or the last financial year, but it did manage to pay out 42 million euros in dividends, which of course is not too much, as we saw is 2.78%. And it also managed to retire 279 million euros worth of debt, which of course is good, step in the right direction. Of course, if it continues to do that with a growth rate, a decent growth rate, retiring debt and not taking any more debt, then the company will do well with regards to being attractive to more shareholders. The foreign exchange effect, of course, 8.22 million euros, which is definitely doing good in that regard. The euro done very well last year, so the foreign exchange effects for companies would have been pretty good, especially the larger companies. Net change in cash was a negative 176 million euros, which of course is not the best thing in the world, but if it spent them on capital expenditures that will yield a higher return on investment, that would justify that amount, that negative net change in cash, then of course, then it's justified. So without further ado, I'm going to close this video. Thank you guys for watching. I will see you in the next one.